What if I told you that the entire Social Security crisis could be prevented with just 5%, and that millions of seniors are being put at risk, not because we lack the resources, but because of a staggering lack of will and imagination? Today, we're uncovering the hidden truth behind the Social Security Trust Fund, the real reason it's bleeding dry, and the simple overlooked solution that could have saved it years ago. Stick around because what you'll learn by the end of this video may completely change how you see the system you've paid into your entire life. This message is for every retiree, every SSDI or SSI recipient, every veteran, spouse, or survivor relying on Social Security to stay afloat. But especially, this is for seniors, because you're the ones being let down the hardest. If you count on a check from the Social Security Administration every month, you need to hear this because what's happening behind the scenes is alarming, and it directly affects your financial security. So here's what's really going on. The government is mismanaging your money, and the data proves it. The SSA's own trustees report spells it out in black and white, yet most people never see the numbers, and even fewer understand how shockingly fixable this problem is. By the end of this video, you'll understand how Social Security could stabilize itself today with one simple move and why it hasn't happened yet. Before we go further, a quick reminder: if you or a loved one are currently on Medicare and struggling to afford the right coverage, there's a completely free resource available. It's a team of licensed experts who shop 20,000 plans nationwide to help you find the one that saves you money and covers your exact needs. Many people are saving over $1,000 a year just by calling them. I'll tell you more about that later, but if you're losing money on a bad plan right now, you don't need to. Now let's break down the problem. According to the Social Security Board of Trustees, the trust fund currently holds about $2.72 trillion. dollars. Think of that as the system's savings account. But here's the catch. In the most recent fiscal year, they drew down that account by $67 billion. dollars. Why? Because they paid out more in benefits than they collected in taxes. This deficit wasn't covered by new revenue. Instead, they dipped into the trust. And here's where things get frustrating. That $2.72 trillion dollars is sitting in U.S. Treasury bonds earning, get this, a pathetic 2.5% annual return. That's just $69 billion dollars in interest last year. In other words, your money is being invested like it's 2005, not 2025. Meanwhile, basic savings accounts and certificates of deposit, products available to everyday people, are yielding 3%, 4%, even over 5% depending on the bank. But your Social Security Trust Fund? Stuck in low yield treasuries that barely keep up with inflation. Let's put that in perspective. If the trust fund had earned just a 5% return, nothing exotic, just 5%, that same $2.72 trillion dollars would have generated about $135 billion dollars in interest. That's nearly double the $69 billion dollars they actually earned. And guess what? That extra income would have completely erased the $67 billion dollars shortfall. No need to dip into the trust. No need to panic about insolvency. Just a basic improvement in investment returns and the crisis is averted. This isn't about risky gambling with retirement money. It's about the government refusing to modernize a system that millions depend on. Lawmakers are starting to speak up, but they've dragged their feet for decades. While financial markets have evolved, the SSA remains handcuffed to outdated rules that restrict trust fund investments to low yield government debt. That may have made sense 40 years ago, but not today. This is where the real emotional impact sets in. Over 66 million people depend on Social Security. That includes seniors, disabled Americans, widows, spouses, and children. These are people who planned, worked, contributed, and trusted that the system would be there for them. Instead, they're watching it unravel, while Washington debates solutions that would have made sense 15 years ago. And if nothing changes, benefit cuts are likely. Some projections show a potential 20% across the board reduction as early as 2033. That's devastating for someone already living on a fixed income. Now, let's clear up a major misconception. Some argue that Social Security is going broke because people are living longer or because too many are drawing benefits. While demographics do matter, the bigger issue is revenue shortfall. The program isn't bringing in enough income to match its promises. And as we've shown, that income gap could be closed significantly, not by taxing more, but simply by earning more on existing assets. So, how did we get here? Let's connect the dots. For years, payroll taxes poured into the trust fund. But instead of using that money to invest wisely and generate returns that keep up with benefit demands, the government locked it into low return vehicles. That was the choice. It wasn't forced, it was a policy decision. And now the consequences are catching up. If nothing changes, the future is grim. Every year, that $67 billion gap will grow. Eventually, the trust fund will be exhausted. Once that happens, benefits can only be paid from current payroll tax revenue, which is only enough to cover about 75% of promised benefits. That means nearly $1 in 4 could disappear from your check. And it's not decades away. It could happen within the next 8 to 9 years unless serious reform occurs. So, what's the path forward? First, modernize the investment rules. Allow a portion of the trust fund, say even just 25%, to be invested in higher yield, diversified portfolios. That alone could bring the average return closer to 5% and help stabilize the fund. Second, adjust the cap on taxable income. Right now, income above a certain threshold isn't taxed for Social Security. Lifting or eliminating that cap would bring in significant new revenue. Third, Congress needs to act now, not when the cliff is 2 years away. Let's summarize what we've learned. The Social Security Trust Fund has enough assets to be financially stable if they were properly managed. Just a 5% return would have prevented the entire $67 billion deficit. But due to outdated investment restrictions, that didn't happen. If Congress fails to act, seniors could see benefit cuts within the next decade. This isn't just about math, it's about priorities. And right now, the system is prioritizing rules over results at your expense. Here's something else to think about. If your personal savings account was earning just 2.5% interest in today's environment, wouldn't you be shopping around for a better rate? Of course you would. You'd be looking at high yield accounts, CDs, or even conservative mutual funds to protect your money and get a fair return. But when it comes to Social Security, the fund that holds your retirement future, the government isn't doing that. It's sitting on trillions, letting it underperform and calling it acceptable. That's the part that doesn't sit right with me, and I know it doesn't sit right with you either. We aren't talking about trying to chase 20% stock market gains. No one's suggesting putting the entire trust fund into risky assets. But even the most cautious investors are finding ways to earn 4 or 5% returns right now. Why can't Social Security do the same with just a portion of the trust? That change alone could literally extend the program's life by decades. And when lawmakers say nothing can be done without raising taxes or cutting benefits, that's just not true. What they should be saying is, we haven't had the political courage to modernize Social Security. It's not a matter